So the Deep Tech Fund started out as this thematic pool of capital that we had investors who were interested in deep tech. So we decided like, hey, let's create a specific fund around this theme. We view deep tech really quite broadly. So at a high level, you could think of, these are companies where there actually is real cutting edge technology. There's usually, a PhD on the founding team. These are often big ideas with significant upside potential if they work, transformative types of ideas. I think the conventional wisdom, which isn't always necessarily correct, is these things are often capital intensive and can be more binary, where you could get really large outcomes. Things like SpaceX, Tesla, I think are examples of ones that have really worked out in the deep tech sector.
Right. Welcome back to the Ignite podcast. Today, we're delighted to have an old friend of mine, Matt Caspari, on the program. Quite the luminary in venture capital. He's the managing partner at Alumni Ventures, where I'm an LP in many different things, including, I think, the fund he manages, or one of the previous ones. And so thanks for coming on the program, Matt.
Yeah, excited to be here. Appreciate the invite. Good to have you.
Yeah, it's good to catch up. We'd love to get an intro from you for the audience.
Yeah, sure. So Matt Caspari, managing partner at Alumni Ventures. We are the most active VC in the U.S., number 3 globally, according to the PitchBook. So I wear a few different hats at Alumni Ventures. I lead our Deep Tech Fund, and I also lead our fund around the UC Berkeley alumni community.
2 funds.
Which is called Strawberry Creek Ventures. Keeps me busy.
Yeah, that's amazing. And that's where we kind of met, I think, was through Strawberry Creek. I think I was an LP in one of the past funds before you got there. And then, definitely we both have the Berkeley
Go Bears
connection. Go Bears. Yep. We definitely love that program. My wife and I both went to that program. So let's talk about your career progression. Let's get the background. I mean,
sure.
A lot of people are interested in, like, how do you get into VC? And I get this question all the time. How'd you fall into it or get into it? Kind of walk us through, what did you want to do when you grew up? Did you do it? And then, like, why did you pick this career of all the careers possible?
Yeah, I mean, I guess starting back in undergrad, I studied biochemistry, so I kind of always had this interest in science and technology. I actually started taking some business classes, so did kind of intro to finance, some economics classes, and decided to go more the business route out of undergrad. Did a year at Bloomberg, kind of a mergers and acquisitions type role, had no technology component to it. I really quickly realized that there was something missing doing just kind of pure business. And I learned about management consulting. So I did strategy consulting, and our clients were large pharma and biotech companies. And I really liked that. So it was this combination of my interest in science and business. I was in Manhattan, but I was doing work with a lot of clients in the Bay Area. So some of the big biotech companies out here. Started to become interested kind of in around entrepreneurship, innovation, venture capital, trying to learn more about that, and really got this idea kind of stuck in my head that I wanted to try and start a venture-backed company. And I started thinking about different ideas while I was doing management consulting, but really thought I needed the time and the space to explore quite deeply some ideas. So I went to business school, saw that as an opportunity to do that. So that's where my Cal connection to my MBA there.
You did the full time, right? It's like 2010-ish?
Yeah, earlier, getting a while now. So
Didn't even throw you under the bus.
Class of 2006. I moved out to the Bay Area in 2004. Yeah, and explored. I mean, I met with kind of a lot of kind of the traditional, well-known Sand Hill Road firms, talked to a lot of professors, ended up starting a venture-backed company out of Berkeley. We won the business plan competition the year I graduated, went on a pretty long adventure doing that. So that's kind of my initial exposure to venture. Yeah. So it's coming up on 20 years ago. Just kind of crazy. Time flies. From when I first moved to the Bay Area, started hanging around VCs. I was the CEO of a couple of venture-backed companies, so that, raising funding from venture capitalists, talking to lots of VCs was just kind of my initial exposure. Over time, started doing some angel investing, really enjoyed that, and that has eventually led to me doing this full time. So I've been called professionally investing for a little over 3 years, but I've been around the ecosystem for a while.
Yeah, that's amazing. What a cool journey.
Yeah, it's
I'm
pretty good.
I'm curious. Alumni Ventures Group. I do hear that a lot. We're the third. Is it the third most active?
Yeah,
Or the most
globally,
active.
in the
The most active.
last 2 years, pitch books are the most active in the U.S. Yeah.
How many deals does one have to do a year to be the most active? I wonder. What's that?
It's a good question. I actually don't know the number off the top of my head. It's probably in the couple hundred per year.
Okay.
Investments. It's a lot. We've got a large portfolio. We also invest across stages, so we'll continue to follow on in companies that we've invested in previously.
Yeah, I need to upload all my stuff to PitchBook because we're doing about 100 a year now at Team Ignite. So.
That's awesome.
Yeah, but we're we're a much smaller check than Alumni. Maybe you could talk about the fund structure between the two funds. Obviously, Strawberry Creek. What fund number are they on? What's the typical fund size? The check size, deployment period. I mean, I see I feel like you're raising fund every year.
So maybe to start at the high level. So Alumni Ventures is the parent organization. The firm started out with funds around our early funds around the Dartmouth and Harvard alumni communities, where our CEO had gone to school. And really a couple core ideas behind Alumni Ventures. One is our mission is to democratize access to venture capital. So this idea of helping individual investors access the venture capital asset class.
And they really, you guys really live up to that mission. It was the very first venture fund I ever invested in, 6-7 years ago now.
Yeah,
it was the Strawberry Creek.
Awesome. We're excited that we were able to get you into the asset class. And and it really had started out with our founder. He was approached by classmates of his, friends that he had known who invested in stocks, bonds, real estate, but they just didn't have a way to access high growth private companies, and we have lived up to that. So the firm's grown a lot. The first fund around Dartmouth was about a decade ago, small fund, and
that
now
recent,
we have
actually. I mean, a decade's a long time, but
not that long, and we've grown to over 10,000 investors across our funds, well over $1 billion in capital raised. And a lot of the ways we structure things are unique to serving these individual investors. So what we've seen is people like the idea of making their annual allocation to the venture capital asset class. So that's led to us raising funds every year. So we come back each year, raise a new vintage. And these alumni funds typically have 20 to 30 companies in them per year. Yeah. So if someone comes back and invests over multiple years, you get that diversification by time. You're also getting exposure to a lot more venture-backed companies. Let's say across Alumni Ventures, we invest, I'd say roughly kind of the majority, call it 50-ish% of our dollars, kind of Series A, B is typical for us. Call it roughly a quarter of the dollars in gross, so C and beyond, and roughly a quarter at the earlier stage, call it seed, even pre-seed, writing smaller checks at those earlier stages and more companies, and kind of the funnel goes down as the companies mature. So that's kind of at a high level.
So new fund every year. When's the kickoff? Like I feel like I just saw it this spring. Is it kind of in the spring that you kind of kick it off? And can you join the fund throughout the entire year? Is there a fundraising period? How's that work?
Yeah, it depends on each fund. So Alumni Ventures has some fund in market at all times. So we're not all raising at the same time. So it depends which fund you're looking at investing into. Typically the funds have different windows where they're actually actively fundraising. We're not right now for Strawberry Creek, the UC Berkeley fund, but we will later this year come back. We host webinars. We explain what the fund is. We promote it. It's kind of like, hey, we're actively fundraising right now. If you want to come in, like this is your window of time to come in. So it's usually several months of the year that these specific funds will be in market. Some of the thematic funds, the deep tech fund is one I'm involved in, but another example is we've had a blockchain fund. I think we did one in about 2018, and then it was out of market for a little while and then came back. It has a little bit to do with kind of the interest from our investor base. So we see from people often, like they'll invest in our alumni funds, which are diversified across different stages, sectors, and then they'll have an interest. They've got an interest in deep tech or health tech, and they're asking us, can I get some more exposure? So that led to this idea of also having some more thematic pools.
Yeah, I love that. And then, so I'm guessing that you're raising 506C on these, so you can talk about them publicly. And
Yeah, I'm not going to go too much of the legal side. I'll let our compliance or lawyers talk about that. But yeah, we are able to raise publicly, obviously. I think we've really led the way on that in terms of
I think so.
Marketing the funds, promoting the funds, letting people know that there is an opportunity to invest in venture, also with really low minimums. I mean, I think historically, most people didn't have access to venture funds. And if you did, often it was, $1 million check or 250,000 kind of minimum check.
Kind of know somebody.
Or minimums. Yeah, really, it's usually venture-backed CEOs could get access to the next Sequoia fund, but, your typical investor couldn't. Our minimums depends on the specific fund you come into, but they're usually something like $25,000. So that provides access to just a lot more people. So that's the model.
Yeah, I love that. We'll talk about the deep tech fund. I wasn't aware that you're in that. Like, what kind of investments are you guys looking at? Anything exciting that you've invested in recently that you can talk about? All that stuff.
Yeah, great question. So the deep tech fund started out as this thematic pool of capital that we had investors who were interested in deep tech. So we decided, hey, let's create a specific fund around this theme. We view deep tech really quite broadly. So at a high level, you could think of, these are companies where there actually is real cutting edge technology. There's usually, a PhD on the founding team. These are often big ideas with significant upside potential if they work, transformative types of ideas. I think the conventional wisdom, which isn't always necessarily correct, is these things are often capital intensive, can be more binary, where you could get really large outcomes. Things like SpaceX, Tesla, I think are examples of ones that have really worked out in the deep tech sector.
Right.
But it's everything from, it could be areas of AI, especially if the founding team really has deep technical expertise and they're creating something novel, covers robotics, space, quantum computing, biotechnology. So it's a quite broad bucket.
That's so cool.
That's
an area I wish I was deeper in, that I, someday at Team Ignite, I hope to have a thematic funds like that, more thematic.
I love it. Yeah.
Have a deep tech fund.
It's things that,
it's exciting.
It's areas that I like to spend time around. What it's not is it's not, kind of call it consumer facing AI. Someone creating an application on top of ChatGPT, really we wouldn't view as deep tech. It's not going to be kind of enterprise software. I mean, there's lots of areas of venture this doesn't cover. So that's a little bit on deep tech.
Kind of like the more moonshot kind of area of venture.
Yeah.
If it works, it's going to work big and be, $100 billion company or more, but a lot of times it doesn't. So how do you guys think about portfolio construction in a space like that?
So our theory really across everything we do is diversification. So we think about creating portfolios with at least enough companies in there to get you some diversification. Again, our traditional alumni funds typically have about 20 to 30 companies per fund. We also look at diversification across sectors. So again, deep tech actually is a fairly wide bucket. So we're not going to invest 100% of this fund in biotechnology companies or space companies. So you're getting some diversification there, which we think is important because some of these zones get a bit frothy or expensive if you don't want to deploy necessarily all your capital into those zones. And diversification by geography. So we're not going to invest all of it in Northern California. We'll look at getting some diversification there. And I haven't mentioned this. So our model at Alumni Ventures is to be a co-investor. So we're not leading rounds. We always co-invest. And our diligence process, we look at all the normal things about a company, management team, traction, competitive moats. In addition to that, we also assess the lead investor. So we're looking at what's that firm's track record in this stage sector. So we get some diversification by investing alongside different leads. We're not going to invest in all of our deals with Lux or Andreessen.
I think the interesting assumption there is that past performance is predictive of future results, which in my classic financial training is not true. But in venture, it seems to be true. And
it does seem to be true. Yeah. I'd say, I think there's these positive feedback loops in venture. So one is the timelines are really long. So if you're a traditional venture capitalist, you're going to invest in 1 or 2 companies per year. You're going to take a seat on the board at the Series A. That company may take a decade to play out. It goes public. It builds, your brand, your reputation. Entrepreneurs want to work with people who've been successful, who've seen the cycle. So I think that's what leads to venture firms, being dominant for long periods of time. I think you have to look back at client
They get
approach has
unique
been dominant for a
access,
long
unique
time.
winning
Yeah,
ability, unique value add ability, and all that is a positive feedback loop into their success.
yeah. That said, like we, especially in the earlier stages, we look for, call it emerging managers, people who've maybe spun out of other funds. You may not have heard of the brand, but we think highly of them. And it's really, if you put yourself in the shoes of an entrepreneur who's world-class and has options, who are they going to choose to raise from?
Right.
And we want to be investing alongside, these investors that really we think are going to deliver returns in the future. And I do think looking at past performance in venture is a pretty good way to look at it. I'd also say that, especially in later rounds, funds that have, a significant amount of assets often have reserves, the ability to attract future capital, especially in some of these deep tech zones. The ability to attract capital is really
fall prey to the sunk cost fallacy where they've invested in a prior round and the company's struggling, so they can reinvest to keep that company alive.
Yeah, or hopefully more like things are going well, but the macro may change. And if you've got a well-established fund that can continue to back you, and there's a board member leading the round who other investors would love to be on a board with them, like that de-risks it a bit.
Yeah.
You have a lot more confidence that this company will raise the next round, even if the macro situation is challenging. So that's a bit of the thought process.
Yeah, I love that. And then, so will you guys enter a round without the lead? Or is it sort of like a soft commit? It's like, hey, once you find the lead, we're very interested and we'll take another look. Is it that kind of conversation?
We really don't run our diligence process until there's a lead. So there's we often meet the entrepreneurs, when they're not raising, they'll know that we're excited about what they're up to. But really, our thesis is investing alongside a well-established lead. So until you don't know the terms, like we're not negotiating terms, we're not taking board seats. So we'll track the company. We really spin up our diligence process once they have the term sheet in place. And we talk to the leads too as part of our diligence. So that's kind of a critical element for us being able to invest, is we've got to have that lead in place. Now, some of the really early stage rounds we invest in have different dynamics. There may not be a lead in seed, pre-seed, it can be a little different, but for, most of the investing we do kind of call it Series A and beyond.
Yeah, Series A and beyond, you typically get a term sheet and it says, okay, we'll invest up to, $2, $4, $5 million. You can go raise another, call it 2 or 3 on top of that, up to that. And then it's like, okay, great. Now you can shop around that term sheet. And what enables you guys to win alongside these kind of tier 1 investors, especially A, because the A and B are very competitive.
Yeah, they are. And that's really our job. What we're doing is providing access. So I'd say what enables us to win? I'd say a few things. Often we're entering the round often through a relationship with the CEO. So we've already explained to the CEO why we think we can be valuable. And that key part of that is our network. So we talk about being a network-powered venture firm. And we have some unique assets. So we have over 10,000 investors across our different funds. And these people went to the top schools across the U.S. So pick, a Fortune 500 company, it's very likely we have investors in our funds who work there. So we've got a unique resource there that we can tap into. We've backed over 1,000 companies. So those CEOs, those executive teams, those venture investors are all part of the network. And we have a centralized team we call CEO services that after we wire an investment into a company, we connect the CEO with CEO services. And there's kind of a set group of offerings that we have available. But really the high level question is like, how can we tap into this massive network to support you? So that's pretty intuitive for CEOs to say like, hey, I think these guys could add value. The other kind of secret to what we're up to is in the name of Alumni Ventures is we leverage alumni connections. So if the CEO went to Berkeley or Harvard or Stanford or MIT, we have funds around those communities. So we leverage those. And when they go back to the tier 1 investors and say Alumni Ventures is interested, we've invested with all these firms dozens of times. So you can pick your favorite firm. Like we've done many deals with them. And I'd say we see ourselves as extremely synergistic with the top tier funds. We're not competing to lead rounds. Again, we're more active. So we're seeing a lot, especially at the very early stages. We cast a very wide net. So we're a good source of deal flow for them, which everyone's interested in that. So we think we're really well positioned to slot into these kind of really competitive rounds. We've had a lot of success getting into them.
And is there like a check size ownership kind of target in any of these stages?
Not ownership targets. I'd say, a typical check kind of Series A, Series B is probably in the 500,000 to 2 million range, but we're flexible. We see ourselves as founder friendly, depending on, the dynamics of the round. We can be flexible.
What about in the kind of pre-seed and seed, or do you guys not really play there?
No, we do. We're actually quite active there. I'd say probably from 50,000 to a few 100,000 is pretty typical, depending on the round size and dynamics. Sometimes we can do more and have, but I'd say that's probably a pretty typical check.
Yeah, that's great. And then as somebody who's been around venture for 10, 15, 20 years, what have you seen change over those years? We'll tackle that question, and then I want to talk about the future as well.
Yeah, I think we saw a really steady shift of power and leverage moving from investors to entrepreneurs. From when I started my first venture-backed company and started in 2006, really up until quite recently, power just moved more and more and more into the hands of entrepreneurs. I think the
dam
terms
cracked when Zuck showed up at Sequoia in his PJs, right? I think that was kind of like
that was a pretty big deal that an entrepreneur had that much leverage. I think entrepreneurs controlling more, and there's bad things that can happen from this too, but I think you saw that. I'd say it's changed quite a bit in the last couple of years, like as the venture funding environment's gotten a lot tougher, as the whole asset class has probably come back down from a very frothy level, one that in my mind is still pretty neutral. I think we're in a healthy place. It's not, I was the CEO of a venture-backed company in 2008. I luckily raised the 20 million round early that year, and we were in a really good position as the market crashed. But having been around that, and a lot of other CEOs I was talking to, things were a lot worse. They were a lot scarier than the last couple of years. So it never got as bad as it can get. I think that's kind of where we're at now, is in a pretty neutral, healthy place. It's, for most,
it's a little bit more balanced, right? Some of the hot rounds are still going fast.
We've seen sharp elbows, preemptive rounds, but those are rare, but they exist, that they're happening like right now as we speak. Some companies are doing amazingly well. I'd say for most companies, it's pretty challenging to raise. VCs are doing due diligence. It's taking time, but they're usually getting the round done, and that's kind of how it should be. And there should be companies that aren't able to raise the next round. That's just part of the ecosystem. The talent and dollars should get recycled onto the next idea. So, when the market's so hot that everyone can raise an up round, that's not really healthy either.
Right.
So I think we're in a pretty decent place today.
And where do you kind of, see venture as a whole going in the next, 3 to 5 years?
I think there's some very interesting trends that are going to impact venture. I think AI is moving extremely fast. I think it has gotten much, much cheaper to create a company, but I think with AI even more so. So I actually think we're going to see venture dollars flow much more into deep tech. So you could look at the percentage of venture dollars that are deployed in deep tech today. I think some numbers I saw is maybe 20%, up from about 10% several years ago. I think it's going to increase significantly. I think there's going to be a lot of entrepreneurs that could raise kind of a small seed round and leverage AI tools. And that's kind of all they need.
Yeah, and maybe never raise again, right?
No, they're not going to have to give up the board seed and control and other things to VCs in order to get profitable. If they're able to do that on a really small check, so I think there's going to be a really interesting ecosystem there.
Yeah.
The traditional venture firms that need to and want to manage a lot of money are going to need to look for other places to deploy it. So I think it's going to end up in some of these more hardware, capital intensive, technologies that touch the physical world. There's a lot of opportunity there. So I think we're going to see that more and more be a place that the venture dollars are deployed.
Yeah, I think you nailed it. I think a lot of folks in the venture community are talking about this right now, which is the democratization of SaaS, the ability to create more and more software powered by AI. AI is eating software. And
Yeah, exactly.
and I'm seeing companies that get to $1 million in revenue without any money raised, and they're like, I don't even know if we'll raise. Maybe we'll raise a little.
I think it's great. I think it's great for the entrepreneurs. I mean, I've always warned entrepreneurs about some of the downsides of venture. I mean, a big one is if you take traditional venture capital, you have to take on the risk to go for that just massive, extremely large outcome. And there's often, for a lot of these businesses, other paths that maybe don't reach that ultimate.
Yeah, they don't get to the
potential
5 billion, 10 billion outcome, but they raise maybe a $500K on 5 pre-seed, friends and family-ish angel kind of round. And then they kind of scale it to, I don't know, call it 5 to 10 million in revenue and have a nice little outcome for everybody.
Yeah. I mean, what VCs would call just a lifestyle business, but maybe a great lifestyle business that's great for the entrepreneur, and they don't have to, deal with the increased risk and complexity of trying to go down the venture path. So I think it's exciting for people. And I'd like to see the dollars go to, these bigger deep tech ideas that, we need to transform energy. We need to transform agriculture. We need to, get into space. I mean, there's all these big ideas out there that really do require dollars that I think if an entrepreneur wants to do something at that scale, like let's give them the resources to go after those big opportunities.
Yeah. What are some of those other opportunities? You named off a couple there, but what are some trends in that deep tech space that you're excited about?
I'd say generally deep tech is quite hot these days, which is awesome because it's been an area that venture hasn't been too excited about. I think we're seeing a lot of people getting excited around robotics, AI potentially being kind of a catalyst to enable some of these companies that were maybe too capital intensive in the past. So I think that's an interesting one. Biotechnology is one that I'd say of all the deep tech buckets maybe feels a little overlooked. So I think the tools in biotechnology, it's kind of amazing. I mean, we hear a lot about AI and kind of these exponential rates, but I think if you look at the cost to sequence DNA, you look at CRISPR, these gene editing tools, I think there's still
using all the AlphaFold open sourcing.
Exactly. It's like
predicting proteins.
There's a lot of very interesting things happening that are going to impact biology. So that's one I'm excited about. But I mean, there's just a lot of super interesting tailwinds behind these deep tech.
I feel like we're really close on robotics too, which is really exciting. I keep seeing all these demos, the OpenAI collaboration. I forget the name of the company now, but obviously.
And Tesla doing a lot. I think we're going to see a lot more interesting demos, even over the next several months. So very, very cool area.
How long till we see like robots just walking through the field picking strawberries?
Dude. It's a good question. I'm thinking of somewhat near term for probably specialized use cases. I don't know if it's going to be walking through the field and with a hand picking them, but maybe something that's something that's optimized for that specific use case. It will be interesting when we get some more general purpose robot that can take on a lot of tasks. I think that's a bit harder, but there are obviously some big companies looking at that. So I'm excited to see what comes from it.
So what would be your advice to entrepreneurs looking for funding, kind of entering this kind of environment of venture capital where it is kind of tough to raise, right? And I see this, right? I see founders reach out to me. They're like, the round's closing next month. I'm like, great, sure it is. Come back when you have a lead. 3 months later, all right, we finally got the lead and we're 20% full in the round. Okay, great. What advice do you give founders in this kind of environment?
That's a good question. I think it's hard. Building businesses is hard. It's not meant to be easy. The stories you heard from a couple of years ago where things are just up and to the right, it's just not how it usually is. Yeah. So these businesses are often painful. They often come really close to dying. And I think if you look back at a lot of the successes, I mean, Tesla's an example of it. Like read through the stories of how hard that was to keep that company alive and get it through. So if you can persevere through it, that's kind of what's expected. That's what makes a great entrepreneur. So as painful as it may be, it's just a little bit of a, hopefully blip on the much larger journey to the vision. I do think being really clear on the vision, I know a lot of people talk about this, but you're trying to attract capital, people, resources to your idea. I think the crisper you can be about the vision, why it's exciting, why it's differentiated, why it's unique, will help with fundraising. I see a lot of pitches that sound very similar to other ones. So understand your competition, look eyes wide open what other people are doing, be able to really crisply answer why your approach is differentiated, different, and why you're going to win.
Kind of a red flag for us as VCs when you see a deck and you've seen 5 pitches in this domain, in this area, call it whatever it is, MarTech or whatever, and they have the competition slide and they don't mention the top competitors that you've already seen.
Yeah, you want someone who's very aware of the competition, just because they should be living this problem and understanding how people are trying to solve it. Like they should want to deeply understand what's going on out there, not for other reasons. But it's like you should be able to very intelligently say, like, that company's doing this, the CEO came out of here, the CTO came out of there, their technical approach is this, like, we're doing this differently, this is why our approach makes more sense, this is why we're going to win. I'd say the other thing is just be really clear on the milestones you're going to hit with the current round of funding that you're trying to raise. And, especially in some deep tech zones, make sure that, the downstream investors are going to agree that hitting this milestone is going to unlock some value in the next round. So an example of that would be if you're raising a seed round, say, I've already talked to a bunch of the Series A leads. They kind of agree, like, if we can hit this milestone, that's going to unlock them coming in and wanting to lead VA. So people don't want to fund, especially in this environment where it's challenging, a company where it's just not clear that even if they execute to the plan, that they'll be able to attract the next round.
Yeah. I often tell people this is a industry of easy yeses and easy nos. And if it's not an easy yes, it's an easy no. I say this a lot. What are some easy yeses for you when you see a startup and you're just like, wow, this is checking all the boxes?
I mean, I talked about our approach to investing at Alumni Ventures. I mean, I'll maybe start there and then get a little more into what I look for personally. I think if there's, a VC leading around, new investor to the company showing high conviction, and we know typically what these firms invest in terms of check size, someone who's been on the Midas list, has done research as a thesis in an area and is leading around and taking a board seat with a high conviction check. That's a really good signal for us that this could be interesting for our model. So that's with our co-investor hat on, that's something that gets us excited. For me, I think a lot about the CEO. I really start there. So understanding, that person's background, where have they come from, what's their journey been. Could be a first-time CEO, could be a serial entrepreneur, but there's something there about the CEO that's getting me excited. I want to understand then the problem that they're going after. Why are they excited to solve that problem? How is that problem solved today? Do I think that you could potentially create a very large business by solving that problem? And then I started to think about the founder problem fit. Is this the right CEO to go after this problem and solve it? And if that's coming together in an interesting way, I'm definitely starting to get excited, especially if they can communicate it clearly. And that gets back to the resources. So if you've got an amazing founder solving the right problem, and I think they're going to be a magnet for world-class resources, people, dollars, then I'm pretty interested. I mean, there's a whole other list of things we look at, but those are kind of the attributes of it.
You don't know this, but I was actually on the investment committee before you got there. And so a lot of how I look at startups is informed by how Alumni Ventures Group looks at startups, right? And I remember the framework's pretty public. I think it's out there on the internet. Or they have found out that.
I think we even did some webinars walking people through it. Yeah. So definitely.
And I definitely kind of
people check it out.
Given my own twist on it over the years, but
sure.
6-7 years ago, that was my foundation, is how you guys look at it. And your deal memos are really long too, which I think is unique. I'm sure you can relate to that.
Yeah, and we've had people on our investment committees that are GPs at large multi-billion-dollar funds for 20 plus years, and people get a lot out of kind of seeing how we evaluate a deal. We have a pretty formal methodology of scoring kind of all these different criteria, everything from the round dynamics. Is it, an outside-led round? What are the insiders doing? Are they coming in for their pro rata or not? To, maybe more typical things, assessing the CEO, the management team, the valuation of the deal, looking at market comps. And for each of these sections, we kind of write up a bit of the analysis we've done on how we scored it, why we scored it the way we did. So that's kind of a key part of our diligence process.
Yeah, and every round is like a snowflake, and every startup's like a snowflake. And you can't just, there's not any one thing that causes you to say yes. But what are some easy no's when you're looking at something and you're like, you're kind of going through your framework and there's like 27 things there that you're scoring?
Yeah.
I mean, not a tier one VC, right? Not a great VC for the round.
Not a great VC. I'd say it doesn't have to be Sequoia. It could be a firm that we think highly of as a specialist VC in a specific zone or stage.
They specialize in fintech in Africa. They're really good. Nobody's ever heard of them outside of the venture community.
Track record. Yeah,
they're really good at what they do.
Diligence in that case would be diligencing the firm. Talk to the lead partner, understanding who their LPs are, what's the reserve strategy. So that could change our diligence of where we're going to focus our attention than if we're investing, with a partner and Andreessen we've done a bunch of deals with. I'd say runway is one that can stop us pretty quickly. We really don't invest in bridge type rounds. So for most, call it Series A, B type rounds, we're really in this market probably wanting to see a clear kind of 18 months of runway.
Same.
So, a 6-month bridge.
We're such a small check at Team Ignite. It's a non-negotiable. If you don't have 18 months of runway, what am I going to do? Like, you have 3 months of runway and I'm going to wire like 1 month worth of runway to you?
It's just not making sense.
Yeah, it doesn't make any sense.
I think as companies, especially as they get further along, the financials matter a ton. And honestly, as companies get to later stage, I really like looking at the financial model on its own, kind of before I even know anything else. It's like, let me look at the numbers. And, if revenues...
I've actually said no quite a bit in due diligence after I look at the model. I'll kind of dive in. I'm like, oh, this is yes, let's start. And this all looks good. And then I start diving in. I'm, CFA Wall Street guy. So I dive into the financials. I'm like, oh, I don't like this. I don't like that.
Yeah.
So I'll find out.
So I think for me, again, especially if it's a bit later stage, if revenue's not growing, if there's, questions around margins not going the right directions, there can just be things in a financial model that are pretty much deal killers that we're not going to invest in kind of a turnaround situation. We just see too many other opportunities that, revenue's growing and
it's capital efficient and has good unit economics, good margins and Yep, all that stuff.
Yep. So that stuff's all important. There's obviously a lot of factors. Sometimes an inside-led round, we do invest into them, but it raises more questions around valuation. Like we'd prefer an outside-led round. I'm not going to say we won't do it, but inside-led round that's the companies fail to attract new investors to lead it isn't typically a positive signal. There are exceptions to that.
Well, let's wrap up with a rapid fire.
Okay.
You feel like AI will be able to do the job of the VC someday, and will the VC job go away?
Oh, this is a quick fire. We could have done the whole thing on this. This is a question I like to talk to people about. So I've actually thought about this quite a bit.
We could take the rest of the time to talk about this question. I've been thinking existentially about this a lot.
I think capital can be decoupled from an individual in the middle. I think there's lots of reasons to believe that at some point a company needs capital. There's LPs, there's pools of capital out there that want exposure to that type of company and it gets matched up by AI. I think there's still a need for expertise and board members, but I don't know that needs to be tied to a company raising capital. So some of the best entrepreneurs in the world I know have built their boards from people in their network who they want on their board. And they've been able to raise very large rounds of capital without giving up board seats because they're just looking for the capital from the VCs. They're not looking for the board expertise. So some of the best entrepreneurs are already decoupling those. And I think AI really could enable that matching really well. I think it may go that way. Maybe it's likely to go that way. We'll see.
That'll be interesting.
It's not going to happen tomorrow, but
no, like anything else, it'll take a decade or two to all play out.
Yeah, I think if you think out a decade and you see the exponential rates that AI is moving, and you think through your workflow and what we do, this conversation, I could have sent my AI to this. And then it's like, well, you send your AI.
Yeah.
And the AI has exchanged the information and they know what my investment
I'm integrating
is.
AI into all my workflows. I mean, Airtable's plugging into the OpenAI API. Like I'm using AI as much as possible to stay lean. And I'm thinking about, for Team Ignite in the future, like, do I actually even want to hire people? I don't aspire to have like a large team, an empire build. I'd much rather keep it really super lean and have, maybe it's a small group of partners working on different thematic funds and stuff like that. But under the hood, it's all AI and contractors.
Yeah. I think that makes a lot of sense. We've been big adopters ourselves. We see a lot of opportunity.
Yeah. And then I'm thinking about, well, maybe I trade off carry share for management fee. If I get to like $100 million fund or something, and it's mostly just AI beneath the hood and just me, maybe I don't need 2%. I don't need $2 million a year.
That could be the future. Yeah.
Yeah, that's funny.
Yeah.
What's your favorite book on entrepreneurship?
Ooh, favorite book on entrepreneurship. I like Shoe Dog. I worked at Nike for several years. I've got a signed copy on the shelf. So, I mean, again, I think you go back to how hard entrepreneurship is, how many times Nike almost died. I think understanding that story. I think there's also some interesting things about, Phil Knight just being willing to delegate and give people space and say, like, go figure it out and do it. So I think there's a lot of good lessons in there. So that's one I'd recommend for entrepreneurs.
And the movie Air what'd you think of that movie? As a fan,
it's just, I mean, it was cool to see, like, as someone who worked at Nike, I think there's just so much that's not accurate that if you know a lot of the details, it's a little frustrating. But it was super cool to see it come out.
What's the most memorable startup pitch you've ever seen?
Man, that's an interesting question. Most memorable startup pitch. I don't, probably not super comfortable giving specifics. I don't have permission to someone to say it. I've had some, when people lead with a story that's super personal and it immediately gets to like the why they're doing this, that's memorable. It sticks with you. It's just like so obvious that this person's going to spend the next decade or 2 decades of their life to solve this, usually because of something deep and personal that maybe why I don't want to name names or say things publicly, but sometimes people have had like traumas in their life or other reasons or things that are motivating them deeply, and you're just like, wow, this person's gonna,
somebody died of cancer or something, trying to really cure this.
Exactly. Yeah. Those stories
kind of things are memorable. Yeah,
those stories are powerful. I think make a pitch really memorable. And again, like we see a lot of pitches that are trying to tell the story of like, truly, why are you doing this?
Yeah.
What's getting you and your co-founders, your team motivated? Some of those pitches can be really, really memorable.
Do you feel like founders have to have a really good why to succeed, or they just have to be really motivated to succeed?
I think the why helps with attracting resources. I think if you don't have a good why, it makes it a lot harder to hire people to get world-class investors around it. A lot of the world-class investors, want to work on the next like really big outcome. So I think having a why that you can communicate helps. Clearly that you can create a successful business without that. I'm not saying it has to be, but I do think it actually makes things easier. So I think it's positive if that's there.
Yeah, well, what I kind of look for is like a little chip on their shoulder. I was like, and I'll kind of disarm them. I'll say, who put that chip on your shoulder? And I'll tell them why I have a chip on my shoulder, which I don't think it's that big anymore. But growing up poor, like I grew up poor and stuff, and so I'm kind of looking for, what's driving them. Like, why are you trying to do this? For
sure. I mean, I they were a very successful entrepreneur who, one of their early VCs, kind of pushed them out of their first company, and that was the driving factor, and they couldn't have been any more motivated. So it's like there's always, the why could be all kinds of things, and I think if you can, if the entrepreneur can articulate that, that's awesome. Or probably for a lot of them, you need to pull it out, but I think trying to understand the motivation, is great.
That's great. Last question: what's the most useful tool you have for productivity? What's your go-to productivity tool?
It's a useful tool for productivity. That's interesting. Yeah, I mean, I've been using this tool, Opus Clip, which takes long-form videos and cuts them down into short clips. So I've been trying to get some more video content out there on LinkedIn and X, and taught myself how to edit video and kind of add these captions. it was taking hours. I mean, I was spending a lot of time kind of playing around with learning how to edit video, and then started looking at some of these tools that are really kind of AI powered tools. So this just lets you upload your video and then it cuts it up and gives you kind of draft content. So that saved me personally a ton of time, and I think it's my latest kind of
I love that. Yeah. And shout out to Opus Clip. I also use it. So if you see my face on LinkedIn or Twitter or YouTube, and it's a little,
that's where it's coming from.
That's where it's coming from Opus Clip. It just takes the entire podcast, and we'll get 10 to 100x more views on those clips than we get on the actual podcast itself. So
crazy. Well, I'm looking forward to watching some of us.
yeah, they'll be out there. So Matt, it was great catching up. Thank you so much for coming on.
Good to see you. Thanks for the invite. Have a great rest of your day.
All right, you too.